Hello. Today we're going to talk about how BP professionals can maximize their savings in 2025. Before we get started, a little bit about myself. My name is Logan Mulloy, and I am an Associate Wealth Manager here at Willis Johnson & Associates. I am a certified financial planner, an active member of the Houston FPA, as well as the Houston FPA Next Gen. Primarily, I work with BP and corporate professionals on their financial planning. Today we're going to cover saving strategies available to BP professionals within the BP Employee Savings Plan, as well as some additional strategies for BP professionals outside of the ESP. Finally, we'll review next steps. If you have any questions, please include them in our follow-up survey at the end of the webinar, and we'll make sure to have a team member get back to you with a detailed answer. We also encourage you to follow us on each of our respective social media channels. First, we're going to talk about the BP Employee Savings Plan and how you can maximize your savings in 2025. First, let's take a look at an example of a BP employee who is over age 50 and earns greater than $350,000 in 2025. First, you'll be able to contribute $31,000 either pre-tax or Roth to the BP Employee Savings Plan. Additionally, BP will contribute a 7% match to the ESP. With it being a match, we want to make sure that we're contributing at least 7% throughout the year in order to take advantage of this great benefit. Within the $31,000 that you can save in the ESP as a BP employee, you have the option to either complete pre-tax or Roth contributions. Let's take a look at pre-tax versus Roth and what might make more sense for you. With your pre-tax contributions, these will go in on a pre-tax basis, which means that you get a tax deduction in the year of the contribution. Furthermore, the growth on these contributions are tax deferred before your eventual withdrawals are taxed at ordinary income rates with your ordinary income bracket at the time of withdrawal. These are best if you are in a higher tax bracket now than you expect to be in retirement. Conversely, Roth contributions will go in on an after-tax basis, which means that you'll pay taxes on these dollars in the year of your contribution. Additionally, these contributions will grow tax-free and eventually be withdrawn tax-free. These contributions are better for BP employees whose tax bracket will be higher in retirement than it is today. Going back to our example of a BP employee who earns greater than $350,000 and is over age 50, you can see here you're able to save a total of $55,500 between your contribution of $31,000 as well as BP's 7% company match or $24,500. In addition to your pre-tax or Roth contributions and the company match from BP, within the BP ESP, you also have the ability to save on an after-tax basis. The way we determine the amount of after-tax contributions that you can make is in 2025, the IRS allows total additions to the 401k of $77,500. And after we determine the $31,000 that you can contribute pre-tax or Roth and the $24,500 of company match, that leaves us with $22,000 that you can contribute on an after-tax basis to the 401k. Beyond the Employee Savings Plan, BP professionals also have two non-qualified plans available to them. First, the Excess Compensation Plan, or ECP, is for employees who earn greater than $350,000 in eligible compensation or their base and bonus. The second non-qualified plan is the Excess Benefit Plan. The Excess Benefit Plan comes into play when a BP employee overcontributes the maximum of after-tax dollars and pushes BP's company match over to the non-qualified plan. Coming back to our example of our BP employee who earns greater than $350,000 in 2025 and is over age 50, again, you can see total savings within the Employee Savings Plan of $77,500. Additional savings could be made here in the Excess Benefit Plan, getting us over and above that $77,500. Next, let's talk a little bit more about after-tax contributions and how they differ from pre-tax or Roth. First, the year you make your contributions on an after-tax basis, they are treated very similar to a Roth contribution. In other words, these contributions go in on an after-tax basis, which just means you're taxed on those dollars in the year of contribution. With after-tax contributions, however, your growth in that source is tax deferred. What that means is when you go to withdraw the dollars, your contributions on an after-tax basis will come out tax-free, whereas your earnings will come out as ordinary income. Where the after-tax source really differs from pre-tax and Roth is at withdrawal. When you withdraw your dollars from the after-tax source, your contributions will come out tax-free, whereas any growth or earnings in the after-tax source will be taxed at your ordinary income rates. Next, let's talk about the after-tax rollover strategy. A lot of BP professionals know that they can make contributions on an after-tax basis to the BP ESP, but you may or may not know that you're also able to roll these contributions over from the ESP. Let's talk a little bit more about what that strategy looks like and how we initiate this process with our clients. The first step to completing the after-tax rollover strategy might be to perform some cleanup within the after-tax source of the BP ESP. How we might go about doing this with a client is to roll over your contributions, your after-tax contributions, to a Roth IRA. The reason we want to roll over the contributions to a Roth IRA is to ensure any further growth is done on a tax-free basis. The next step would be to take any earnings in that after-tax source and roll those out to your IRA. The reason we'd want to roll to the IRA is to preserve the tax-deferred treatment that the growth had within the after-tax bucket. If we instead just rolled over your contributions and growth to your Roth IRA, you would have to pay tax on the growth from the after-tax source. The final step for this strategy is to roll over your IRA back to the BP ESP in order to complete the backdoor Roth strategy in the most tax-efficient manner. We'll revisit the backdoor Roth strategy in a few slides. To recap what we've covered thus far, let's go back to our example of our BP employee who's over age 50 and is earning over $350,000 in 2025. In total, this individual can save $77,500 in the BP employee savings plan. Next, let's take a look at the investment options available to you within the BP ESP. As you can see on your screen, a list of the investment options spanning from target date funds on down through individual funds. Typically, what we see with these target date funds is that they become more and more conservative as you approach the respective target year. However, these funds are not built specifically for your needs. Instead, what we like to do is take a consultative approach where we get to know our clients and their needs and wants for these dollars and build a portfolio tailored for them using the given investment options. Another investment option available to BP employees within the employee savings plan is to invest directly in the BP stock fund. If you are someone who has invested in the BP stock fund historically, you may have an opportunity to withdraw these dollars in a more tax-efficient manner. This strategy is known as net unrealized appreciation, or NUA. If you were to take a normal distribution from the BP ESP, you would be taxed at ordinary income rates for the full amount of your distribution. Conversely, if you were to complete the NUA strategy, you're taxed at ordinary income rates up to your cost basis, or $50,000 in our example, where the remaining $250,000 between the market value and cost basis would be taxed at long-term capital gains rates, which are typically more advantageous. While this strategy appears straightforward, there are other tax and planning considerations to review before executing. So far, we have covered savings strategies available within the BP ESP. Next, we're going to move into additional saving strategies available for BP professionals outside of the 401k. First, we're going to look at the Health Savings Account, or HSA, available to BP professionals who are enrolled in the high deductible health plan. In 2025, if you are a BP professional enrolled in a self-only high deductible plan, you're able to make contributions of $4,300. If you are a BP professional enrolled in a family plan, you're able to make contributions to your HSA of $8,550. Additionally, if you're over the age of 55, you also receive a $1,000 catch-up, which will allow you to make additional contributions to the HSA. Additionally, BP will also match up to $1,000 of contributions to your health savings account. These contributions can be withdrawn at any point tax-free for qualified medical expenses, and at age 65, these dollars can be removed for non-medical expenses but would be taxed at ordinary income rates similar to an IRA withdrawal. The next thing we're going to talk about is the vesting of your share value plan shares. As you know, these shares are granted to you without having to make any election. Because of that, the strategy really comes at vesting. The way these shares work is they're granted to you in year 1 and then vest 3 years later. Because of this, we want to take a look at our strategy once these shares do vest. When looking at the vesting of your share value plan shares, there are 2 different strategies we like to take with our clients. The first might be to realize these gains immediately after vesting. Reason being, it is taxed at short-term capital gains rates, but there's little gain or loss built into these shares if you act quickly. The second strategy might be to wait until these shares reach long-term capital gains. The reason this could be more advantageous is because long-term capital gains rates are typically more advantageous than short-term capital gains rates. The third strategy we're going to review is backdoor Roths. Earlier we discussed the backdoor Roth as a strategy, but let's dive in a little bit more into the steps to complete this. So why could the backdoor Roth strategy make sense for you? If you make greater than $236,000 and you're married filing jointly, or if you make greater than $165,000 and you're filing single, you can't make direct Roth IRA contributions. However, there are no income limits for making an after-tax contribution to a traditional IRA, and also no income limits for making a conversion from your IRA to your Roth IRA. So how do we complete a backdoor Roth strategy? The first step is making a non-deductible IRA contribution from an after-tax source. That after-tax source could be from your paycheck, checking account, or from a brokerage account. Once we've completed the IRA contribution, next we'll want to complete a conversion of those dollars from your IRA to Roth IRA. The reason we like this strategy is we allow those dollars to continue to grow on a tax-free basis in your Roth IRA. One thing we want to be aware of is what's called the pro rata rule. The pro rata rule states that when you complete the conversion portion of moving IRA to Roth, whatever portion of those dollars in your IRA are pre-tax will be taxable upon completing this step. In order to avoid the pro rata rule, what we might want to do is roll over any pre-tax dollars currently in an IRA into your 401k or BP ESP. Earlier, we discussed this as the final step of the after-tax rollover in order to complete the backdoor Roth strategy in the most tax-efficient manner as possible. Let's take a look at an example. In this example, this individual has $70,000 in their IRA. What you see is $63,000 worth of this is pre-tax, whether that be from an old employer's 401k, previous pre-tax IRA contributions, or if you completed the after-tax rollover strategy from earlier without rolling the pre-tax dollars back into the 401k. Additionally, you see the $7,000 here of after-tax contributions as part of the backdoor Roth strategy. If you were to do the backdoor Roth strategy without the rollover of pre-tax dollars back to the 401k, you would be taxed pro rata on the amount of pre-tax dollars in the IRA. In our example here, you see $700 worth of the $7,000 conversion are tax-free because that is the portion that was made of your after-tax contributions. Conversely, $6,300 of that $7,000 conversion are taxable to you. Instead, what we do to avoid the pro rata rule is a rollover of your pre-tax dollars into the BP ESP before completing the $7,000 Roth conversion as the final step of the backdoor Roth strategy. Let's take a look at the impact of completing the backdoor Roth in the most tax-efficient manner possible. By completing the strategy here with the steps we've gone through, you'll have additional pre-tax in your BP ESP of $63,000. Let's review the impact of completing the backdoor Roth strategy using the steps we've talked through in our given example. Completing the backdoor Roth strategy in the most tax-efficient manner allowed us to get $7,000 of after-tax funds over to your Roth IRA, where these dollars will continue to grow tax-free. Additionally, we've rolled over the $63,000 of pre-tax balance in your IRA back into the BP ESP to allow for backdoor Roth conversions in the future in the most tax-efficient manner. In total, this reallocated $70,000 to continue to grow in the most tax-efficient vehicles. Another important consideration when completing the backdoor Roth strategy is the filing of Form 8606 with your tax return. If you work with a CPA, you want to make sure that they're aware that you're completing the backdoor Roth strategy so that they can include this form with your tax return. If instead you are filing your own tax return, we have resources available on our website to help you complete this form with your tax filing. We've covered a lot of saving strategies between the BPESP as well as additional saving strategies outside of your 401k. So let's take a minute to take a step back and review what we've covered thus far. In 2025, a BP employee who is over age 50 and earning greater than $350,000 can save a total of $94,050. These savings are made up of the 7% BP match of $24,500, your employee contribution of $31,000, either pre-tax or Roth, your after-tax savings of $22,000, completing the backdoor Roth strategy of $8,000, as well as the health savings account contributions of $8,550. If you are a BP professional between the ages of 60 and 63 in 2025, you'll also have additional savings opportunities. In total, you'll be able to save $98,800 between the ESP as well as additional saving strategies outside of the ESP. The changes here from our last slide are the additional $1,000 catch-up to your health savings account for a total of $9,550. But the big change in 2025 with the passing of the Secure Act 2.0 is the additional catch-up contributions that you can make on a pre-tax or Roth basis to the ESP. In 2025, as an individual who is between 60 and 63, you'll be able to save a total of $34,750 pre-tax or Roth to the BPESP. We've covered a lot of different strategies today between the BPESP as well as additional saving strategies that we like to help our clients complete. If what you heard today was interesting to you and want to ensure that you are taking full advantage of the benefits available to you, come talk to us. Our job is to be a financial coach, walking you through the process each step of the way to ensure that you are educated on your options and able to make the best decisions for you and your family. If you like what you heard today and are interested in meeting with us, we offer a complimentary 3-meeting process. During these meetings, you would meet with one of our advisors where you would talk through your company benefits, tax planning and optimization, and investment portfolio review, including recommendations. This will give you the opportunity to see what it's like to work with us and the types of recommendations we can offer to help you reach your goals. So who are we? At Willis Johnson & Associates, we are an award-winning firm. We have structured ourselves as a fiduciary. We can offer great advice in your best interest without any hidden fees, commissions, or kickbacks. By structuring our firm this way, we've positioned ourselves where we can give great advice to clients with a very low conflict of interest. If you have any questions, please include them in the pop-up survey following the webinar, and we'll ensure that a team member will follow up with a detailed answer. You can also follow us on LinkedIn, Facebook, or YouTube in order to see our latest articles and commentary about the information we've covered today. Thank you for joining us today. We hope to have the opportunity to meet with you soon.